let's tackle the first question I want to pose to everyone is, what do hurricanes and data breaches have in common? Now, we've seen in the news and heard about the data breach of 143 million personal records, and it's now, I think, getting up to about 145 million personal records that were exposed by the Equifax data breach. And we've witnessed the impacts of hurricanes, the major hurricanes, Harvey, Irma, and Maria this season, plus the most recent Hurricane Nate that hit the Gulf area in the past few weeks. So I'd like you to think, what do these things have in common? So if this were Jeopardy, we'd ask you to write the answer down, and we'd present you with the clue, and we'll award you the money. We'll move along. So what do hurricanes and data breaches have in common? Well, I mean, it's not a matter of if they happen, it's a matter of when they happen. And I'm thinking on a global basis in terms of our country or the United States and many areas that are exposed in the coasts. Sometimes the response I see or hear from organizations is one of surprise when these things happen. And we know that these events can happen, and they do happen. So this leads me to our next question is how do we address them? So part of that is really focusing on how we think of the current environment that we're in. And you know, we need to ask the question, how do we address these things? Why do we need something like enterprise risk management? And I'll get to the definition in a moment. We need to start thinking about the unthinkable, whether we're working in a governmental organization dealing with the water quality crisis, like in Flint, Michigan in the past couple of years, running the Olympic Games in Rio de Janeiro with the threat of the Zika virus, a law firm based in Panama that no one had heard of before, but that had its computer system hacked and had ramifications globally for a number of high-profile people, or holding a Bastille Day celebration, or running a nightclub. Whether we're working for a major cell phone or automotive manufacturer and we discover that our product has major flaws in it, a bank that suddenly discovers that it has shady lending practices, manufacturers who are facing changes with Industry 4.0, what is robotics and automation that is changing the way that manufacturing and processes are done, or voting or election results that are unexpected. Every organization these days needs to address the new normal. So what are we talking about when we are looking at this new normal? What's the definition? And this is not a definition that I came up with. It's one that's common in the military environment that goes back a number of decades, comes out of West Point and some of the Army's military doctrine, and that's what's called the VUCA environment. So the new normal working environment is characterized by one that has a high degree of volatility, a great degree of uncertainty in terms of our assumptions and in terms of our parameters that we're dealing with, an increasing level of complexity, especially when we think about the interconnectedness of our current world, and where we're confronted by situations with a high level of ambiguity. So let's step back and look at what is enterprise risk management. Now, there are a lot of different definitions of enterprise risk management, ones that are put out by the International Standards Organization, or ISO. There's the COSO guidelines that are out there. Some of these are familiar to our council members, to the people who are participating in these. If you boil all these definitions down, essentially what enterprise risk management is it addresses the uncertainty associated with achieving an organization's strategic objectives. It deals with strategic and operational risks, not just what we would consider insurable risks. And we will come back to this last point in just a moment to help us understand some of the key differences in terms of traditional risk management versus enterprise risk management. So ERM processes and functions are comprised of what we would see in a traditional risk analysis: scanning, identifying, and analyzing risks, treating, monitoring, and managing risks to assure that the organization is able to achieve its highest optimal outcome, and finally establishing things such as continuity plans, emergency management functions, systems contingency, and disaster recovery plans to address the ability of the organization to, or the capabilities to recover from disaster or emergency situations. Now, how does enterprise risk management address the new normal working environment? Well, let's go back to volatility. Volatility in the market demands some vision, the ability to manage change and to be able to seize the opportunity and be able to take action. Uncertainty requires understanding of the connections between different aspects of our business, and the variety and different functions and the global span, certainly for those organizations that are larger, and with those connections with the wider world, with vendors, with partners, with customers that may stretch far beyond what would be the organization's borders. The increasing complexity of our world drives the need for greater clarity and also creativity in terms of how we address these things. We always can't come up with the same solutions that are going to address the problems that we're facing. And ambiguity impels the need for attention, for focus and flexibility in addressing risks. So ultimately, in an unpredictable and complex world, the long-term success of an organization largely depends on the capabilities to plan for and manage risks and to be able to recover from unforeseen disasters, or those that we have a limited amount of information on. And enterprise risk managers are the professionals who are tasked with helping their organizations navigate their path by identifying and managing the potential negative outcomes that are associated with some risks and with the upside and downside of other risks. Well, let's come back to the difference between better practices of enterprise risk management and what has been the traditional role of risk management as a practice. Risk management breaks down into four main quadrants traditionally. We're talking about financial, strategic, hazard, and operational risks. And traditional risk management is usually focused on managing financial and hazard-based risks, such as commodity price fluctuations, credit risks, liquidity, liability, property theft and damage, and weather-related hazards. Now, these risks are typically dealt with through insurance or financial contracts to transfer or mitigate the risks. Now, enterprise risk management seeks to explore risks on the strategic and the operational side, not only with financial and hazard risks. And they're not traditionally covered by insurance. So addressing risks such as budgeting overruns, new projects, protectionism in international markets, negative media coverage, product recalls, or supplier or vendor problems. And also, as we've seen, IT systems failures, whether those are hacking issues or where systems just fail. Now, let's go further into looking at this issue as to why it's important, why ERM is so important. So now, why are strategic and operational risks important? And this chart illustrates some survey results. So based on a survey by the Corporate Board Company among the top 20% of the Fortune 1,000 companies between 1998 and 2000, the root causes of decline in market capitalization can be broken down as follows. 68% can be attributed to strategic risks such as a decline in core product demand, poor integration with acquisitions or mergers, or infringement of competitors into their marketplace. And we can see this clearly in examples with Amazon that's moved into new markets, with Google, and so forth. 13% of that market decline can be attributed to operational risks, such as corporate restructuring, poor forecasting of product demand, or abrupt changes in commodity prices. So these categories are what we can call traditional or non-insurable risks. And yet, cumulatively, they account for 81% of the total root causes of market decline and capitalization. So let's explore this from one other point of view. And this chart may be familiar to many of you who are participating in the webinar. In the new normal, when it comes to looking at the traditional axes of probability and impact, where the scale of the latter, we're talking about impact, is from 0 to 100% losses due to an event. The probability curve, as you can see, is not a strict bell curve, but rather, the highest probability of events is in the lower impact events, and then the long tail trails off along the lower probability, higher impact events. And I'll come back to this towards the end of this. Most of the events that fall into the majority of the curve would typically be covered. Okay, they are they would be covered under insurance. However, events that have a major impact where losses can possibly put the company or the organization out of business are not usually insurable. Now, these infrequent events and high impact events are what often referred to as black swan events. And, move forward there. And you may have heard or read the book, The Black Swan, The Impact of the Highly Improbable by Nassim Taleb. It's a very good read on the subject. And what we're now seeing is that the ability of predicting these high impact events is now questionable. So, and I've heard this recently when it comes to Hurricane Harvey, and I've also heard it in terms of some of the cyber hacking events and exposures. And this is the issue around, well, we didn't know this is going to happen, or these are unpredictable events, or they're one in 1,000 years, 1 in 800 years. The reality is that a lot of these things were known. They were known that they could be issues. If you look back at the historical record, in some cases they could have been foreseen or predicted, at least some of the impacts, and I think to a certain degree some of the probabilities of them. Again, for these types of events and for the whole portfolio of risks, enterprise risk management can help to manage all quadrants of risks. Now, let's just talk about how we address this in our program. So the Katz School Enterprise Risk Management Master's Program builds competencies in 4 key areas: in enterprise risk management, which includes risk analysis, control, forecasting, management of risk information systems and technologies, legal frameworks, compliance and audit, security and safety requirements, understanding of finance, including accounting, economics, finance, and insurance, skills in statistics and analytics, a working understanding of data collection, description, modeling, probability, hypothesis testing, regression, time series analysis, decision analysis, trend analysis, and forecasting, sort of the basics of statistics. Management skills, including planning, organizing, leading, and evaluating, strategy, operations, and project management. And these competencies are based upon the Risk Insurance Management Society, or RIMS, model, and correlate closely with those among enterprise risk management roles across a range of industries. So this is based on hard work and research that we did in looking at the multitude of different jobs that are out there. We did a very thorough analysis to build this out, and also we've consulted with our faculty in looking at and building this program out, and as I mentioned, with the close guidance of our advisory council. So our program's courses collectively address these competencies, covering the core of enterprise risk management, including planning and compliance, as well as risk modeling. And one elective in this area addresses the certification preparation for the RIMS Certified Risk Management Planner. This is a relatively new certification, while the other one other elective addresses cybersecurity, which is an area that's top of mind for risk managers in all organizations. Financial and insurance risk management targets essential financial skills and an understanding of the traditional method for addressing risks. And financial risk modeling and quantitative and qualitative decision making addresses some of the hard skills in statistical analysis. Foundational management competencies are covered by project management and business continuity planning and its companion, emergency management, which are key areas that enterprise risk managers are increasingly called on to play a role in, as evidenced by conversations I've had with many risk managers in a wide variety of areas, that they're being called into meetings and they need to be able to sit down at the table and be able to speak to and understand the implications from their risk portfolio that they're tasked with managing. So I'd like to talk about what distinguishes our curriculum from others in the educational market. There's a lot of great programs out there, but I think what really sets us apart is that Yeshiva University helps our students understand not only the what and how of ERM with the methodology and toolkit, but also the why. And our program overall prepares students with a solid toolkit derived from leading global best practices. And by global, we mean in the case studies and the projects that you'll be exposed to, as well as looking at different ways in which ERM is applied out in the real world, and by practitioners who've worked in a multitude of different countries. I speak with my advisory council members on a regular basis. Usually it's en route from one place to another. So, and they cover the globe from Asia to Latin America to Europe to Africa, and certainly North America. Yeshiva University is a top-tier institution. It's located in the heart of New York City, which allows us to connect to students with leaders in global and cutting-edge practices of enterprise risk management. We're speaking to you from our offices in Midtown Manhattan at 33rd and Lexington, and so we have access in a short walking distance to some of the global players, in the marketplace in a variety of different industries. Coursework is practical and project-based, so you'll learn by engaging in better practices, using real-world case studies and project work from our leading practitioners, many of whom are with us today. The other thing I'd also like to point out is, unlike a lot of programs that are out there, our courses are just not off the shelf. We're building this program organically from the ground up, based upon the competencies that are out there, with a view towards industry, using real-life case studies. We're using fresh case studies within the last 5 years or so, not sort of older. Where we can learn from older examples and scenarios, we will use them, but we really want to keep things relevant to what's going on, because there's been a lot of change in the last decade, and certainly a lot within the past 5 years or so. The other thing is our program is accredited for options in classroom or 100% online. And this allows for flexible scheduling by our students, allowing you to complete your master's degree if you're pursuing it full-time in a 16-month timeline on average, or our 24-month part-time program on average. So I'd like to address what types of industries and what sort of what type of companies our graduates might come from. So graduates of the program are targeted to employers from diverse industries, such as information technology, transportation and logistics, allied health and pharmaceutical, consumer products, government and large NGOs, and financial services, as well as real estate, but also large engineering firms, and there's many other companies that really need someone with the depth and expertise of a risk management, enterprise risk management approach to address placing a system in there, or building a system, and helping handle that, manage it cross-functionally throughout the organization. One of the last things I'd like to reaffirm or point out is one of the key factors, again, that distinguishes our program from many others in the educational marketplace is that we mostly rely on industry practitioners with current experience at senior levels in enterprise risk management practice areas across a range of industries. They bring that experience and their leading edge practices into the classroom, using those real life examples and keeping them fresh from the field. So the teaching's not just on concepts and methodology, but how to apply them where the rubber meets the road in the workplace. So there are a number of folks that are listed here. I can point to each and every one of them and provide examples, but for example, Dr. Eugene Stern, who works at Bloomberg, he's responsible for building the risk management practice on a global basis and building that in for portfolio managers to analyze their risks on an up-to-date basis. He has a depth and wealth of information and experience in this area. What greater person to learn this from? And again, these are individuals like Dr. David Whipple and others who are on our call who are working in this field and are coming back from travels throughout the world where they're implementing cybersecurity for their firm, and they're giving presentations and interacting with leading people from the United States, North America, to Europe, Israel, and Asia, and really getting exposed to really leading edge practices, but also being able to implement them and knowing what's working. They're the people that are working really on the front lines and understanding what they are from a systemic point of view. And our students have access to that level of expertise. So that brings us to our next part, which are any questions that you may have. See, we have one question that's come up here. So the question is, how can ERM deal or help with healthcare organizations dealing with the volatility surrounding the Affordable Care Act, or ACA, sometimes referred to as Obamacare? And for those who may be attending from outside the country, this is basically a law that was implemented during the previous presidential administration that requires greater access to healthcare. And introduces that, creates markets on the state level, on the national level when they're not provided, pools those so that healthcare coverage could be extended to a broader range of people. Some of the recent changes that are being put into effect restrict subsidies for some of those policyholders. And so to answer this question very specifically, so insurance companies by and large are very risk averse because they have to meet certain benefit requirements. And I think if you look at how they responded to this, a lot of the premium costs have already been built and factored into. In other words, they anticipated that this was going to happen, and so that was largely factored into their pricing. So from an enterprise risk management point of view, they understood what their risk tolerance is, which is relatively low. They could factor in what their appetite is for risk because they do deal with this on a regular basis, and insurance is regulated at a state level, so a lot of these things are having reverberations on the state level. At the national level, there's certain insurance contracts certainly that come into play, but ultimately what it comes down to is they factored that in, they built it into their premiums so that they wouldn't have to face any risks when it came to changes that would occur in the marketplace. And I think that we're going to increasingly see that costs will increase for certain services or certain companies doing business because they have to anticipate those types of changes, and they have to do it ahead of time. They can't wait 6 months to a year for things to be put in place. So the next question is, how does ERM deal with the increasing effects of climate change? Well, I will just make a statement that I am not a meteorologist, and I'm not I'm not a climate scientist. That being said, having studied the impacts of climate change and sort of seeing how it's played out, I think a lot of it depends on the exposure. So again, ERM looks at the risk portfolios, what our exposures are, what's likely to happen. And again, you look at that, you look at what the potential impacts are. So let's take, for example, the recent wildfires out in California. So when it comes to folks who work, for example, in the wine country, in Napa, Sonoma, and those areas, certainly those companies that are going to stay in business are those that have anticipated this and the potential catastrophic losses to their vineyards, because it will take minimum of 5 years to grow back those vines. So how do you mitigate that? Well, one clear way is through insurance. The other is to have alternative sources for grapes outside of your immediate area, to be able to source. So that's, when you think about it, that goes beyond just the traditional insurance way of dealing with it. It goes beyond it into how do we proactively take action. Again, if you look at it from an enterprise risk manager's point of view, that's going to help that organization, whether it's a winery, whether it's a second or third party that's involved in that value chain, sort of address those supply chain issues that are going to come up in that specific marketplace. Okay, so what is my outlook for the future of enterprise risk management? This is a very big question. I will address this question initially, but I'd like to call upon my our advisory council members, and if I, please don't be shy, I'm going to call on you one at a time. I'll just take a first crack on it, and then I'd like to hear their opinions on this. So I think that the enterprise risk management, when we look at the risk and insurance markets or the industry, there's, I'd say, three big trends. One is in artificial intelligence. One is in big data and data sciences, and the third is in the changes in the job market. So the first one is in artificial intelligence. We're seeing a greater reliance on the use of machine learning and predictive analytics to take a look at large data sets, so that gets to our big data. And insurance companies have access to huge data sets within their own companies. There's also public information that they can gain, and then there's information that they can purchase, and pooling that to get a better understanding of how to address claims, so they can improve the speed to being able to fulfill a claim, to also identify those claims when they're screening them, to find any malfeasance or errors that are associated with claims. So those are a couple of different trends, right? The big data and data sciences, looking at the analytics of how they can improve their processes. And then the third is changes in the job market. So we're seeing greater automation and use of robots and machine learning, as I mentioned previously, that will change the nature of work. And we're seeing this in automated or self-driving cars. We're going to see changes in white-collar jobs as well. We're already seeing that, where jobs are being either supplemented or replaced in some cases. So we're going to see fewer people doing fewer jobs, so to speak, or less work as a whole in some sectors. And when we look at insurance specifically, for example, when we look at claims adjusters, so if we need fewer people to go out there, that changes the nature in which how we're insuring the work that's going on. So the claims adjuster that used to go out to the field, who would assess the damage for, let's say, a given building, now, we can send in the drones, we can gather information remotely in many cases, sometimes through sensors, to be able to then make a decision without having to send somebody. That changes the nature of having to insure the car for the person to go out, or their liability in going out there. Now we've got to look at how do we insure the drones and the work that goes out there. That's just one small example. Oh, I'd like to ask Celia. I'm going to open up your microphone, Celia. And Celia, can you hear me?
Yes.
Okay, great. Well,
can you hear me?
I can hear you fine. I think everyone can hear you on the. Oh, please. So, do you want to take a crack at this question?
Well, I first want to. Yes, I'll take a crack at a few questions. So, with regards to the insurance markets and the latest catastrophes, the 3 hurricanes and the fires in California, it's going to have an immediate impact, I would say, in the first quarter, mostly of 2018, in that the traditional insurance for property, those premiums have been going down and down and down for the last several years, and I would be very surprised if the insurance markets did not take this as an opportunity to correct themselves and get some rate increases where they haven't been able to get them in the past. Chubb, which is one of the biggest market shares because they own ACE now, ACE and Chubb, and AIG have both already posted large losses. And so I think there's going to be an impact on increased costs of traditional property insurance. With regards to the use of drones in adjusting losses, I think that that's not something that's going to happen as fast as you might think for a variety of reasons. One, the use of drones to some degree is regulated. So we've had an experience here where the insurance company wanted to use a drone on something, and I pushed back on them because I really wanted a human adjuster. I wanted to be able to have a conversation and a dialogue because there's some strategy involved in adjusting a loss. And it's not a black and white issue. Plus, the use of drones is they have to had to get permission from Homeland Security. So, maybe 5, 10, 15 years from now it'll become a regular practice, but it's not something that's, common yet.
So I should mention also, and I apologize, Celia.
Okay.
Celia Levitt is the Director of Risk Management for Yeshiva University, and she is an advisory council member. So one of the members of our advisory council. So thank you for sharing that opinion. I'd also like to call on Raj Bora. I'm gonna unmute you. Raj, can you hear me?
Sure. Hi, Andrew. Can you hear me?
Hi. Yep. And let me just do a quick introduction. So Raj Bora is an executive vice president at Willis Towers Watson, which is a major reinsurance company. Raj, you want to answer this question?
Sure. Just talking about the future of enterprise risk management, and you laid out a few points. I just want to kind of maybe from an insurance perspective talk about two other points. One is just the change in our economy from sort of a physical-based economy to an economy that's really driven by intangible type assets. Obviously the hurricanes this year continue to remind us that there's definitely a lot of physical assets and personal assets and real issues that can still be damaged dramatically, in bad type hazard events. However, on the cyber side, we're learning that what insurance is sort of designed to do may not respond very well to the new economy. So the insurance industry has to figure out a way and is looking for people to help it design products and coverages that address sort of brand and reputational risk type things, damages to companies due to failure of IT processes in various ways. So the future of the insurance industry is going to be learning how to look at it more holistically in terms of what are the the risks that need to be insured, that need to be covered. And the other thing I want to kind of talk about is just the scope of the insurance system. I mean the hurricanes and the fires and the actually there's the earthquake in Mexico this year. Will end up being about $100 billion loss to the U.S. insurance industry. Now, I mean, this is an opportunity for the insurance industry to kind of perform its social value, its social function. $100 billion of claim payments will be made to the policyholders, which will go a long way in at least helping with the economic loss, some of the economic loss due to these events. However, the total economic loss, including what the government will bear and what individuals will bear beyond what they'll be covered by insurance, was going to approach north of $300 billion. So there's a gap between what the insurance industry is able to do or what its reach is and what the actual loss is out there. And some of that gap, could be driven by changes to the climate as stuff in the past no longer is a great predictor of what might happen in the future. So the insurance industry is going to be looking for opportunities to work in sort of public-private partnerships with governments to help improve risk management and maybe find better and more cost-effective ways of financing risk going forward as governments become more, cost-constrained, but still are able to perform a function, but just need maybe that partnership with the private industry to kind of provide that funding, that capital. So those are two areas I think that new entrants into this space can really make a difference.
Thank you for that, Raj. I wanted to also get a viewpoint from one of the folks who works in our cybersecurity area. I'd like to start with Dr. David Whipple. So, David, are you still on the line?
Yes, I'm here.
Okay. Dr. David Whipple is the Chief Information Security Officer for Apple Leisure Group. And David, do you have some insight into the question that was asked about the future of ERM?
Sure, I do. At least from the perspective of cybersecurity within an organization, what I'm seeing between myself and my peers and the industry is there's a shift in addressing risk from an IT point of view, which is show us a return on investment for what we give you, to a risk-based approach of addressing cybersecurity risks. The insurance industry that's requiring more and more things on top of everything else so that they can give us adequate coverage, especially in cyber risk events, are is taking us more away from the IT side of the house and into the finance side of the house. I'm seeing a shift among a lot of my peers. Instead of working for the CIO, they're actually working for the chief risk officer or the chief financial officer that is in charge of risk. So I think that's kind of an interesting thing that's happening here recently in the cybersecurity industry.
Interesting. Well, thank you for that point of view. And lastly, I'd like to ask Amy Tal, who is also a cybersecurity specialist. Amy, can you hear me?
Yes, I can. Can everyone hear me?
Yeah, sure. Amy, I know you're a cybersecurity specialist with a wealth of information. You used to work for Deutsche Bank most recently. Do you want to comment on the topic of where ERM is headed in the future?
Absolutely. I mean, the first thing I have to say is the outlook is brilliant, and I think courses like yours are very timely indeed and a requirement. Businesses are still, if anything, right now being bombarded with a multiple of internal and external risk, making risk mitigation a key for any business that's looking to foster growth or grow. So it's become more of a whole business thing in generating not just the finances for the organization, but looking at reputational damage, regulatory issues, etc. So I think, number one, the required skills are going to be needed. And if there's one example more than any that shows that the skill set that your university is looking to train students so that they're out there in the market and they can utilize is the Equifax hacking itself. I mean, you're looking at a situation where we know that 143 million people were affected, 209,000 credit card records were taken. But in addition to that, we know also that this wasn't just a US problem, it's a global problem, because we now know that 627,000 UK citizens have been affected as well. Having said that, this is an organization that did not take cybersecurity as seriously as they should have, bearing in mind the weight of the data and the importance of the data that they carried. So there was a lot of negligence there, and really a lot of people are now looking at it to really say that part of this was based on the lack of in-depth knowledge of security and expertise. We're talking about patches in their systems that were known to everybody. They actually attempted to patch, and the patching didn't work, so they just left it. They had no breach notification plans, which you need to have in place, no cybersecurity programs in place, or adequate measures to handle it. And when the incident did come to light, the way they even handled it, the haphazard way of doing it, just showed the lack of experience and expertise and skills and forethinking of what needs to be done in a situation like this. Now, when we're talking about risk, a lot of organizations now are looking at more proactive. We've gone beyond just being the reactive where something happens, you investigate. It's about putting controls in place, processes in place, looking at the technology and the people. And this is a very, very key element of enterprise risk management. You look at, again, all the incidents that have happened. You look at the New York in particular that actually passed in March the cybersecurity regulation, just goes to show how important it is. So when we're looking at risk, we're looking at from every single facet of discipline out there or organization, be it public or private. We're looking at it not just internal, but also the externals. We're looking at it from a point of not just the cybersecurity, but even the physical security, etc. So it's definitely happening. The opportunities for anybody going into industry, I believe, is really huge, because we are always going to be progressing and stepping towards the proactive side of things. I think my colleague that just spoke earlier about seeing the shift and everything is more risk-based than anything else, that's absolutely right, because it's now recognized with the ramifications and the penalties that some organizations, including the financial sector, have received in with regards to the huge fines. It's actually cutting into the profits of the organizations. You're then looking at reputational damage, and I think everybody will think twice before dealing with Equifax again. So I think absolutely the outlook, as where I'm seeing it from a cybersecurity point of view, as well as just from a business growth point of view, the outlook is great if anybody's going into this field.
Okay, so the last question is, what type of students are we looking for in enterprise risk management? Well, I alluded to what we're looking for in terms of various industries, and really one thing I wanted to highlight is we are looking for folks who are in the finance industry, but really also looking at those are in the non-financial industry. There's a tremendous amount of growth in how ERM is being adopted in non-financial companies. 75% of the market is non-financial companies. And so, there's a range of, I think, really interesting and challenging problems to be resolved, those that require some footwork and some real assessment. And talking to Dr. Stern about his work prior to being at Bloomberg, he had worked at had done some work at a public product of a consumer products company. And he said to me it was incredibly interesting work looking at the supply chain, looking at the market risks and things of that sort. So, there's a lot of opportunity there. To get to the specifics in terms of the type of student that we're looking for, we are looking for students that have some experience that they're going to bring to the classroom, ideally 2 to 3 years of experience, if not a little bit more, a range of different industries. It would be good to have some level of business background or background in finance, but not an absolute requirement. So we're looking for folks who may come from the traditional insurance industry, from finance, from business intelligence or analysis, from the IT world. They may come with a management degree or some management experience, but sort of in that area. If they don't come with it, we will find some students that may come to us with just the undergraduate degree, but will have some experience having worked, in doing some internships during the summer, or part-time during their school year. We will supplement that experience with some internships provided by our faculty and our advisory council members in the risk field, so they'll get up to speed. Ideally, we want them to apply what they're learning and understand it within the context of a working environment, an organization, and the industry in which that organization works. So that sort of describes what we're looking for. There are also basic requirements in terms of grade point average and requirements for test scores, etc. Those are on our website. We do not require any standardized testing, but there is a level of assessment that we do ask for students to go through. So that, I think, basically describes the types of students that we're looking for.